Today's discussion centers around a fascinating article detailing a potential threat to the recent stock market rally. The S&P 500's impressive surge, adding $18 trillion in value, might be facing a significant headwind.
Indeed. The seemingly unstoppable rise of the market, fueled by factors like anticipated tax cuts and the AI boom, now faces a formidable challenge. Treasury yields exceeding 5%.
A 5% yield threshold seems arbitrary. Is this purely psychological, or is there more to it?
It's a combination of factors. While the 5% figure holds psychological weight, it also represents a significant shift in the relative attractiveness of bonds versus stocks.
So the higher yields on treasuries are making bonds a more competitive investment?
Precisely. They offer a safer return, impacting the cost of capital for companies and potentially triggering a stock market correction.
The article highlights a sharp increase in treasury yields, particularly in the 20-year and 30-year bonds. Can you elaborate on the significance of this rapid rise?
The speed of the increase is unusual, especially considering the Federal Reserve's recent rate cuts. Historically, yields have remained relatively flat or shown modest increases after such cuts. This rapid jump is raising concerns.
And the market's response?
The market reacted negatively. The S&P 500 experienced its worst day in months, wiping out some of the gains from the previous euphoria. This underscores the sensitivity of the market to these yield increases.
The 10-year treasury yield is particularly crucial. What's the concern surrounding its approach to 5%?
The 10-year yield is a key indicator, and reaching 5% is seen as a potential trigger for a significant market correction. It's a level that hasn't been consistently breached in quite some time. Some predict a potential 10% drop in the S&P 500 if it hits that mark.
What's the underlying mechanism driving this potential correction?
Rising bond yields make treasuries more attractive, increasing the cost of borrowing for companies and reducing the relative appeal of stocks. This can lead to investors shifting their funds from equities to bonds.
The article mentions the earnings yield of the S&P 500 falling below the yield on 10-year treasuries. What does this signify?
This indicates that the return on a significantly less risky asset, treasuries, is now higher than the return on the S&P 500. This makes it harder to justify the current valuation levels of stocks, especially if earnings growth slows.
So investors are essentially getting a better return with less risk by investing in bonds?
That's the core issue. The risk-reward equation is shifting in favor of bonds, potentially leading to capital outflow from the stock market.
What are some of the predictions from market strategists regarding the future of the stock market?
There's a range of opinions, but many anticipate a bumpy road ahead. Some predict a challenging period for equities, while others see a buying opportunity in bonds. The overall sentiment is one of caution.
Are these predictions solely based on the rising yields, or are there other contributing factors?
Several factors are at play: sticky inflation, hawkish central banks, increasing government debt, and uncertainty surrounding the incoming administration all contribute to the current market climate.
The Federal Reserve's role is crucial. How does their policy of lowering interest rates factor into this situation?
The Fed's rate cuts are intended to stimulate the economy, but the pace might be slower than anticipated. This, combined with other factors, creates a complex scenario that's different from previous periods of rapid rate hikes.
So the Fed's actions aren't necessarily a counterbalance to the rising bond yields?
Not entirely. The impact of the Fed's actions is being offset by other economic and political factors, making the situation more nuanced.
The article suggests that big tech companies might be a relative haven during this market uncertainty. Why is that?
Big tech companies, particularly the Magnificent Seven, continue to demonstrate strong earnings growth and substantial cash flows. They're also positioned to benefit from the AI revolution. Investors often seek high-quality, stable companies during market turmoil.
But are even these tech giants immune to the broader market trends?
No, they're not entirely immune. Companies with the highest valuations might be the most vulnerable, and even big tech could experience some pressure. The key is to focus on quality and valuation.
The article emphasizes that the reason behind the yield increase is as important as the increase itself. Can you explain that?
A gradual yield increase reflecting economic improvement can be positive for stocks. However, a rapid increase driven by inflation concerns, a growing federal deficit, and policy uncertainty is a significant red flag. The why provides crucial context.
So the context of the yield increase is more important than the number itself.
Absolutely. A yield increase driven by positive economic factors is different from one driven by negative factors. The market interprets these differently.
The article mentions investor complacency as a contributing factor to the market's vulnerability. How does that play a role?
Bullish positioning in the face of high valuations and policy uncertainties creates a fragile market. Complacency can amplify the impact of negative news, making the market more susceptible to corrections.
So essentially, overconfidence is making the market more vulnerable to shocks.
Precisely. Overconfidence and a lack of preparedness for potential downturns can exacerbate the impact of negative events.
Inflation is another key factor. How does it interact with the current market dynamics?
Rising prices, a strong job market, and a robust economy can all contribute to increased inflation. The incoming administration's policies could further influence inflation, adding another layer of complexity.
So the combination of rising yields and potential inflation creates a double whammy for the market.
It's a significant concern. The interplay of these factors creates a challenging environment for investors.
Given all these factors, what advice would you give to equity investors?
Proceed with caution. Focus on quality companies with strong balance sheets and cash flows. Be valuation sensitive and avoid overly speculative investments. The market is likely to experience volatility in the coming months.
Is there any reason for optimism amidst this uncertainty?
The Fed's rate cuts, while potentially slower than expected, offer some degree of support. The relative strength of big tech companies also provides a degree of stability. However, caution remains paramount.
So a balanced approach of caution and selective investment is key.
Exactly. A well-diversified portfolio focused on quality and valuation is crucial in navigating this uncertain market environment.
What should investors be actively monitoring to gauge the market's trajectory?
Closely monitor the 10-year Treasury yield, inflation indicators, and the overall economic climate. Pay attention to the Fed's actions and statements, as well as the unfolding political landscape. Staying informed is crucial.
That was a great discussion. Thank you for your insights.